Welcome, dear traders. This week is quite uneventful in terms of macroeconomic reports, and it's also a short week due to Labor Day celebration on a Monday. The recently released US jobs data caused a mixed reaction in the market. The Nasdaq index saw a minor dip, although the three major indexes primarily trended upwards last week and closed in a positive territory. In the coming days, traders will focus on the data on the ISM Services PMI, as well as on the manufacturing orders and foreign trade data. Statements from Federal Reserve members are poised to set the tone for investors. The financial landscape is always full of surprises and noteworthy developments. Stay tuned and watch this video till the end. Share your thoughts in the comments below. Last week, labor market data took center stage. While the non-farm employment report for August slightly outpaced expectations, the revised data indicated a less impressive employment growth for June and July. Wages growth also stalled. Additionally, the unemployment rate climbed to 3.8%, the highest reading since February 2022, reinforcing market sentiment that the Federal Reserve may pause a rate hike this month. The probability of a September rate increase plummeted from around 20% last week to roughly 7% post-employment data publication. The Dow Jones closed higher by 116 points on Friday, while the S&P 500 gained almost 0.2%. In contrast, the Nasdaq registered a slight drop following the non-farm payrolls release. This week, investors will keenly observe the data on initial jobless claims, with the forecast expected to show average figures. While such data may not elicit considerable optimism, the absence of bad news will favor the stock market. In the second half of the week, a number of Fed leaders will speak at the annual FinTech conference in Philadelphia, where they might reveal their plans for their next meeting. In the absence of other significant news, market players will assess this meeting to find any clues regarding further rate hikes. If the likelihood of a more tightening becomes higher, we can assume some slide in the stock market. Last week, the Dow Jones added 0.6% as the financial market witnessed a notably rally across the board. However, such a rise may turn out to be a trap. The sentiment in the US stock market considerably improved after a slew of macroeconomic data had been released, and these reports indicate a deceleration in economic growth amidst high interest rates. This came as a surprise to the market, which had grown accustomed to a strong economy. This slowdown bolstered hopes that the Federal Reserve may reconsider tightening its monetary policies. Such expectations seem to be rather bold given the hawkish rhetoric, heard by the majority of the FOMC members in the recent days. A year ago, at the Jackson Hole Symposium, Jerome Powell called for patience in tackling inflation. Yet, it appears that the time is ripe to take measures. The Fed's perceived delay in responding can be attributed to resources accumulated during the pandemic, both over household and corporate levels. Elevated governmental expenditures also persist, leading to a record US budget deficit. Such a backdrop hardly bodes well for a sustainable foundation for economic growth. Enthusiasm spurred by expectations of a more dovish stance might quickly wane as the reality of declining revenues becomes more apparent. Notably, the rise in the S&P 500 index came after the likelihood of an interest rate hike in November decreased from 62.2% to 50.7% compared to 42.2% in the previous week. This significant shift has undeniably captured the market's attention. The broad-based S&P 500 index posted a minor gain of 1.9% for the past week. Last week, the index showed steady growth, leveling out more than a half of the decline registered in August. Analysts at Morgan Stanley expect the U.S. stock market to close the year with a strong advance. The S&P is projected to reach 5,000 points by the year end, up by more than 10% from the current levels. Bank experts say that the shares of 7 large corporations, namely Apple, Amazon, Alphabet, Meta, Microsoft, Nvidia, and Tesla, will maintain the upward trajectory and remain pillars of support for the market. Despite solid growth, all 7 leaders, with the exception of Nvidia, are still below the 2021 year-end levels. These companies reported robust quarterly results and they are considered less vulnerable to geopolitical risks. Meanwhile, a SNBC survey suggests that the U.S. stock market may not be able to sustain its gains over the next 6 months and will end 2023 lower than current levels. In the short term, investors will focus on levels above 4,500 points on the S&P, and the ability to maintain upward momentum will confirm bullish dominance in the market. However, if the index returns below 4,450 points, it may indicate a possible false breakout that occurred on Tuesday. Last week, the Nasdaq saw the most dramatic change with a 2.6% gain. Is there anything to be optimistic about? Indeed, the market has been positive for a long time. The uptrend is still intact. However, it's also difficult to ignore some pitfalls. Higher interest rates can increase the financial burden on borrowers and slow economic growth. Plus, some countries are already experiencing a slowdown in economic activity leading to a recession. Also, inflation is still a concern, and the Fed is leaving the door open for another rate hike. And we can also add the crippling banking sector, the slowdown in the Chinese economy, as well as the corporate and household debt burdens to this list. In the U.S. stock market, most hedge funds and professional managers are bearish. Most likely, they have a reason to keep their short positions open. The volume of shares brought back by companies in the U.S. stock market has fallen significantly. Share buybacks have often driven prices higher over the past 13 years. However, these repurchases are no less effective. Falling oil inventories are another sign of the coming rise in oil prices and inflation. This is happening alongside OPEC's production cuts, which are regularly extended. And the situation in the stock market looks tense from a technical point of view. Prices keep trying to overcome the 2022 level, but this seems extremely difficult in the current environment. Long-term 10-year yields also suggest a decline, which may force investors to abandon risky assets. In general, all of the above factors and arguments may point to a correction in the stock market that has long seemed impossible. Monetary policy tightening has reached its limit and many seriously damage both the economy and the stock market. Higher oil prices may support prices for goods and services in the United States, and this leads to the conclusion that the second wave of inflationary pressure is just around the corner. The following companies made headlines last week. Tesla's stocks dropped by 5% after the electric car maker cut prices on 2 of its US models. Stocks of Dell Technologies soared by 21.1%. MongoDB by 3% and Lululemon by 6%. on a better-than-expected quarterly results. Meanwhile, investors are getting ready for Apple's 2023 Worldwide Developers Conference. On Tuesday, September 12, Apple will unveil its new products during the event called Wanderlust. This event is expected to cause increased volatility in the coming weeks, which could be a good opportunity for active traders. Apple's stocks may reach $195 per share, opening the path to $200. You can be sure that the next stock market review will be issued just in a week on September 12. The InstaForex team will be glad to receive your comments, questions and estimations. We wish you profitable trading and stay tuned with us. See you soon!